Hi everyone, my name is Sarah Smith. I'm a licensed life insurance agent, and I am going to be teaching you guys how to pass your life insurance exam on the first try. This is video number 2 of 8. It'll be an 8-part series where I will go through 200 prep questions with you guys and give you the answers and do my best to explain why those answers are what they are. If you have not seen part 1, go back and watch it. Couple of disclaimers, I'm in California, so not most, but maybe half of these questions are California specific. Of course, we know that insurance is governed by the states and not federally. So each individual state has its own set of insurance laws and they vary. So anything, if you're not in California that says California, disregard that question. Everything else should mainly be vocab and should be pretty much standard across the board, and it should help you to learn the general information well enough to pass your exam. At the end of this 8-part series, so on video number 8, at the end of video number 8, I'm going to give you guys a little treat. It is a test taking tip that I would teach when I used to teach this class to help other agents that were new to our organization who needed to get licensed. And a lot of them would call me, out of the blue after they would take their test and say that it was extremely helpful. This little trick helped me to pass my life insurance exam and my California real estate exam on the first try. So I hope that it will help you guys to alleviate some of your test taking anxiety enough to be able to pass the first time. So stick around, make it through the entire series, or just skip ahead to the end of part 8 if it's out. I will also be linking, I created a Vocab Quizlet because I would also teach in this class that when you first learn all this information, it's like a foreign language, right? So you have to know your vocab because that's where you start when you learn a foreign language. So I created a vocab Quizlet with all of the insurance terms that I could find. I used Excel to study. That's what our organization uses. So all of the insurance vocab terms I found, I put into a Quizlet, which I will put in the description box below. All right, without further ado, I'm going to share my screen and get into these questions. Okay, perfect. I think you guys should be able to see my screen now. So I left off the first video. We're doing 25 questions per video. That's why it'll be 8 videos. So we are starting this video with question number 26. I've got my cheat sheet here just in case I need it. So let's go ahead and get started. So which of the following does not have to be included on life insurance policy illustrations? I'm not going to read the questions out loud because I want you guys, if you're an auditory learner, just to hear the question and then the answer. So this answer is going to be C, statement that all values and benefits are guaranteed. We know that, especially on indexed policies, we do not guarantee values, right? 27, Jerry is an insured who understated his age on his life insurance application, paying $12 per 1,000 of insurance instead of $15 per 1,000. If he dies, how will the adjusted death benefit be calculated? This one's going to be 12/15 of the policy's base amount. Moving on to question 28. A terminated employee that has exercised the conversion privilege is able to convert what? This one's going to be term group life coverage into permanent insurance. And I will go over this one a little bit with you guys. So the conversion privilege we know is when you work for a corporation or company and they have a group insurance plan, right? And you are an employee, you are a participant in that insurance plan, you have a certificate of insurance, and then you either lose your job or you leave your job. You have 31 days to exercise your conversion privilege and convert your term, right, your renewable term group life insurance plan into permanent insurance. Now, I would always explain that the privilege part of this, because this is pretty important, the privilege of the conversion privilege is that you do not have to prove insurability. So if you are somebody that has a condition like some forms of diabetes or perhaps a chronic illness that renders you uninsurable by a private company, you can still right? Qualify because you don't have to prove insurability through your company's group plan. If you should leave that company or get fired, you can take that amount of coverage that you had and convert it into a permanent policy, still without having to prove insurability, which means that's kind of a loophole for you to be able to get coverage for your family if through a private company you would be otherwise uninsurable. So that's what I would always explain the privilege part of the conversion privilege to be, is that not having to prove insurability when you do convert to permanent. Number 29, retirement plans are prevented from favoring highly compensated employees under which government regulation? Now we know that the government is all about non-discrimination, right? So it's going to be B, non-discrimination. Question number 30. The Medical Information Bureau consists of tattletales, I would always say. This is going to be life and health insurance companies. So as you guys become more experienced agents and you start having clients that you put in applications for, you will see sometimes if you miss something, or if the client, didn't disclose everything, maybe they forgot or were trying to hide something, you'll see that you'll get emails back from the company saying, Medical Information Bureau records show surgery on a state, or show, that this prescription was prescribed for this ailment, and you said that they didn't have this on their application. So pretty much you can't really hide things from the Medical Information Bureau unless they are not in a client's records. So this is going to be life and health insurance companies. They're going to talk to each other, and that life insurance company is going to get the medical records from the health insurance company and say, hey, by the way, you forgot to tell us this thing. So tell your clients to be as honest as they possibly can. A modified endowment contract, or a MEC, is described as what? And this one's going to be a life insurance contract which accumulates cash values higher than the IRS will allow. I'll go a little bit deeper on that one for you guys. So we know that these cash value life insurance policies are a really good alternative to something like a Roth IRA for your wealthier clients, right? So your wealthier clients that make more than $208,000 combined, at least that's what it was for 2022. I don't know what it is for 2023, but more than $208,000 in a household, they no longer qualify for a Roth IRA, right? So that's where we say, hey, you can start funding a cash value life insurance policy, and you can still get a lot of those benefits of the tax deferred growth, the ability to access it tax-free, right? You're cash tax-free, and you don't have that income ceiling that the Roth IRA does. However, it's still a balancing act, right? So, sometimes you're going to have higher cash values, but a lower death benefit, or you'll have a higher death benefit, but lower cash values, right? So there's a ceiling on how much the IRS says that you can put into that policy every single year. So once you go above that ceiling that the IRS says you're allowed, whereas in a Roth, it's $6,000 a year, in a cash value life insurance policy, that ceiling is going to be based on how much insurance is being purchased in that contract. So if you go above that ceiling, let's say, your client can put in $10,000 a year and they go and put in $11,000, it becomes a modified endowment contract because it has cash values higher than that IRS ceiling of $10,000. I hope that was helpful. 32, what type of license is required for an individual who charges a fee to review an insured's existing life insurance policy? This is going to be a life and disability analyst, because they're going to analyze the policy that you already have. They can charge a fee to do that. When calculating life insurance premium rates, which component is affected by an insured's age and gender? This is going to be your mortality. Now, of course, we know that men of the same age as women, they will always be a little bit more expensive because you guys y'all know what you do, right? Y'all be doing some things. So your age and your gender are going to affect your mortality, which means basically the company says, we think you will pass at this age, this date, and we're going to charge you X amount per 1,000 of insurance. Which of the following is not considered to be a definition of the term loss? So I want to walk you guys through this one because there are going to be a couple questions that are like this. And I hope that by walking you through this one and helping you translate what each of these answers are saying, you will learn how to do that for yourselves. So this answer is going to be A, the probability that an event will occur, right? Because once you have the word loss, it means that it's happened. There's been a loss of some sort, right? Some sort of disaster, you crashed your car, your house flooded, or you passed away. So probability that an event will occur is the answer because it's not a definition for the term loss because it's the probability that it might happen. So let's walk through the other three answers to see why they are definitions of loss. So one is an insurable event that takes place, which results in a payment made by the insurance company. So from a life insurance standpoint, an insurable event that takes place would be a death, or if you've got living benefits, a qualifying illness, which results in a payment made by the insurance company. So you had an insurable event take place where then you had to file a claim and the company paid out. That is a loss, right? Unintentional decrease in the value of an asset due to a peril. So unintentional decrease, so it unintentionally went down in value of an asset due to a peril, which is, we know, a bad event, right? So let's use a car accident in this case. So your car is your asset in this case, and unintentional decrease, an accident, right? So an accident is going to unintentionally decrease the value of your car due to a peril, which is the event of the accident. The amount an insurance company must pay because of an insurable event. That's a loss, right? The amount of money that the insurance company has to pay because of the car accident or the death, which is the insurable event. So each one of those, if you walk through them, defines loss. Which of the following is not considered to be advertising? This one's going to be a rating from a rating service company such as AM Best. So advertising, we do that through the illustration, right? We're advertising that this is the potential, right? Values and benefits are not guaranteed. This illustration is showing you the potential of what this policy could do for you in the future. So I'm advertising that to the client. A sales presentation, of course, that's advertising, or direct mailing from an agency, advertising. But saying that this company is, whatever, AAA rated or A rated by AM Best is not advertising. It's just putting that information out there to show how solvent the company is and how able they are to make the claims that they are promising that they will make. Which of the following is a circumstance in which there is a possibility of both a loss or a gain? Both loss or a gain. This one's going to be speculative risk because we're speculating, right? Is it going to go up? Is it going to go down? That would be something like a variable policy or any sort of marketable securities, right? We don't know what's going to happen. Right now, the market's been pretty down, but a couple of years ago, it went down crazy and then it went back up crazy, right? So another example of that is gambling. We could lose money and we could make money. Speculating the outcome, it's a speculative risk. How are Roth IRAs treated for tax purposes? Okay, this one's going to be non-deductible contributions and tax-free distributions. Now, if y'all don't know the difference between a Roth IRA and a traditional IRA, I would definitely suggest looking that up. I'm trying to decide if I want to draw it out for you guys. I won't draw it, but I'll explain it. So there's differences between the two different types of IRAs, right? So IRA stands for Individual Retirement Account. So your Roth IRA, you pay taxes on the money in the year in which you contribute. But because you already paid taxes on the money that went in, you do not need to pay any taxes on the money that comes out, on the withdrawals, on the gains, right? So huge benefit. How much money would you want to put into that account if I said, this is what the account does, right? You put in money that you pay tax on, but if it grows to $1 million, you don't have to pay taxes on that money. You would want to put in as much as possible, right? Well, of course, that's why the government puts that $6,000 a year max, because they're trying to limit the amount of tax-free money that you have, right? So a traditional IRA works the opposite way. Like a 401k, you get to deduct the income that you made that you put into that traditional IRA in the year in which you made the contribution. However, as it starts to grow, any of that money that you take out, that growth, you pay income taxes on that. So if down the line you've amassed a huge amount of money in this account and you don't have as many deductions on your taxes every single year because you're a little bit older, and you're not deducting your mortgage interest anymore, and you're not deducting any children that are staying at home, it can kind of end up biting you later on because you will be in a higher tax bracket and you'll have to pay income taxes on the money that comes out of your traditional IRA. So that's the difference between traditional and Roth IRA. And if you're going to be in this industry, I highly suggest you know how to explain the difference to your clients. Which of the following refers to a condition that may increase the chance of a loss? So when you are driving and you put on your Google Maps or you put on Waze and there's an accident up ahead, what do they say? Hazard reported ahead, right? Hazard is something, some sort of peril that is increasing your chance of a loss. So if there is an accident that's already occurred up ahead, it's telling you, hey, be careful, because if you keep going at the same speed and it hasn't been cleaned up yet or something, there is something up ahead that will increase your chance of an accident yourself, which is what we would categorize as a loss, right? So a condition that may increase the chance of a loss is a hazard. Variable life insurance and universal life insurance are very similar. Which of these features are held exclusively by variable universal life insurance? I think I mentioned in the first video that there are certain words or phrases that should cue in your mind another word or phrase, right? They're key phrases and they should connect with each other. So once you know your vocab, and once you know those key phrases, basically the question's giving you the answer. So in here, variable, I said before, if you see variable, something in your brain should go, oh, I'm choosing something. I'm choosing where cash value can be invested, or I'm choosing the investment that will provide the greatest return. I'm choosing something, right? And then universal is characterized by flexibility. So in this case, with a variable universal life insurance policy, that variable and that universal together basically is saying you have the flexibility to provide the investment that you believe will provide the greatest return. So your answer is going to be D. Policy owner has the right to select the investment which will provide the greatest return. 40. Which of the following describes the statement, the more times an event is repeated, the more predictable the outcome becomes? And this one's going to be pretty easy, right? The law of large numbers. The more times we see something happen, the more times we can say it's probably going to happen like this because we've gathered more data. Under a group life policy, the insurer will issue an individual blank to the policy owner for delivery to each person insured. So let's break this down, right? So under a group life policy, that tells me that it is a life insurance policy that is owned by a corporation for the benefit of the employees, right? So group life policy. The insurer, which is of course the company, the insurer will issue an individual, the answer is going to be certificate, to the policy owner, which would be the corporation, for delivery to each employee, each person insured. So you, the employee, do not own that policy. The company does. They own the master policy, and that master policy will issue a certificate of coverage to each person insured. So I would say master policy, and I go like this, and I would say, just like, a little octopus, all the employees are all the little legs. So they're going to get a certificate of the coverage for their little leg. Which of the following would not be accomplished with the purchase of an insurance policy? It would definitely give you and your family greater peace of mind. It would definitely give you the ability to make payments for covered losses. And of course, it would reduce the uncertainty of how you would pay for losses, but it cannot eliminate the risk that those losses would occur. So the answer to 42 is B, risk is eliminated. Purchasing an insurance policy can't do that for you, sorry. 43, what is involved when a life insurance policy has been backdated? And this one should be pretty simple. This is making the policy effective on an earlier date than the present, right? Backdate. Which of the following does the California Insurance Code not require an insurance policy to specify? So the answer is going to be A, because the insurance policy, of course, would have to specify the policy period, how long it will last, the premium, how much you'll be paying for the coverage that you'll be getting, and D, what or who is being insured. Of course, you have to know who the thing being insured is, who the person being insured is, right? Is it your house? Is it your car? Is it your phone? Or is it you yourself or your significant other? So what is not required on an insurance policy is the insurer's financial rating. Which of the following is a contract that involves one party which indemnifies another when a loss arises from an unknown event? Now, this is what I'm talking about when I say you have to know your vocab, because this is like a foreign language, right? So if I were to be sitting here teaching you French and you don't know how to speak French, I would say a full-on sentence or paragraph to you in French, right? But if you don't speak French, you're going to look at me like I'm speaking gibberish, because I am pretty much. But if I sit back and I say, okay, let's just take this sentence. This word means this, and this word means this, and this word means this. You would have a pretty good understanding of what that sentence was, right? Because you broke it down. This is what you're doing with this as well. So which of the following is a contract that involves one party which indemnifies? So you have to know what indemnify means to pass this test. Indemnify means to restore an insured to the position that they were in before the loss occurred. Restore the insured to the position that they were in before the loss occurred. So what happens when you crash your car but you have insurance? You crash your car and you make a claim with your insurance company, and they say, okay, your car was worth this much, so we're going to cut a check, to you, or if you have a loan, they'll pay off your loan. We're going to restore you to the position that you were in before this thing happened. We're going to give you the money to get you back to, square one. So that's what indemnity means, indemnify. Restore the person to where they were before this thing happened. So which of the following is a contract that involves one person doing that to another person? Well, that's just an insurance contract, right? That's a really, really fancy way of just explaining what it is that we are basically giving to people through their insurance contracts. If something happens to you and you have a chronic, critical, terminal illness or critical injury, or you pass away, we're going to give you the money so that your family can be in the same financial position before you passed away, so they don't lose their house, and have to move and things like that. So A, insurance contract. 46, an annuity, which is backed by a life insurer's separate account, is called what? And this is going to be variable annuity. So separate account is the proper name of the account. Separate account is not like, oh, it's just a separate account. So anytime you see separate account, your brain should click through your vocab and know that separate account goes with variable policies. So if you see separate account, know that the answer is probably going to be variable. So in this case, it is B, variable annuity. Those two go hand in hand. What kind of life insurance policy issued by a mutual insurer provides a return of divisible surplus? And this one I'm going to draw out for you guys. And your answer is going to be participating life insurance policy. So what kind of life insurance policy issued by a mutual insurer provides a return of divisible surplus? So we know mutual insurers, the policy owners are basically shareholders in the company, and that gives them the right to participate in this divisible surplus. So let me go ahead and do a new share with a whiteboard and give you a quick little synopsis of what that means, divisible surplus. So as a company, obviously every company is about their profits because they want to stay in business, right? So if this mutual insurer makes 100 million in, we'll say 2022, now it's January of 2023 when I'm filming this. So let's say they made 100 million in 2022 and they're looking back at all of their, books and, oh my gosh, whatever. Their liabilities were 90 million. What is their surplus? Their surplus is this 10 million right here. Now they're going to take that 10 million and they're going to divide the surplus, right? Divisible surplus. So let's say, this person and this person and this person are all policy holders. So they're going to take that 10 million and they're going to divide it up by their policy holders and give them each their share of that 10 million. So let's say you have a term policy with this company for $300 a year. And your portion of this 10 million is $20. You get your divisible surplus for 20 bucks. You can say there's different options of what you can do with it. You can say, okay, I want to purchase additional coverage for whatever $20 can get me. If I'm paying $300 a year for a term, let's say it's for 20 years and it's for $250,000. So maybe that $20 can buy me, I don't know, I'm not the best at math. Maybe that 20 bucks can buy me an extra like 30 grand of insurance. I can say, hey company, I want to use this 20 bucks to buy an extra 30 grand. So now I have 280 grand, right? 5, 6, 7, 8. Okay. So I have, 280 grand now. Or you can say of this 20 bucks, I want to take $20 off of the $300 that I owe you. So it's going to be, instead $280 that I owe you this year for my $250,000. I think I did not do it correctly on it would get you 30 grand because whatever. You understand the gist, right? So there's different options of what you guys can do. You can either say, I want to add, paid up additions is what it's called. I want a paid up addition of coverage for whatever my share of the divisible surplus was, or I want to take my share of the divisible surplus and take it off of what I owe you for this year. So there's different options that you have for that, but that's basically what divisible surplus means. And it's a participating policy. So if it was not participating, it would not pay dividends. An endorsement found in an insurance plan which modifies the provisions of the policy is called what? So your key phrase here is modifies provisions of the policy. And this is going to be a rider. So you'll hear something like a spousal rider, a child rider. What other kind of riders are there? Like your living benefit rider, right? Your ABRs, your what other kind of riders? Yeah, that's good enough, right? So spousal rider, child rider, your living benefit rider. It's just saying I'm adding this thing on. Paul has an existing annuity and has sold a new one, in which the new policy holds no greater financial benefit to him than the existing contract. This is considered a what? If the new policy holds no greater benefit to him, this is going to be an unnecessary replacement. And basically, the Department of Insurance will not allow you to do that because there's no point aside from for you to make a commission, which is not in the best interest of the client. So I know for myself and my company, we have living benefits, which, some companies out there don't. So if I can look at somebody's existing life insurance policy and they don't have living benefits, probably 9 times out of 10, I can say that, hey, there's an additional benefit here, whereas they'll have, living access to their death benefit if something happens to them. They have a qualifying, chronic, critical, terminal illness, critical injury. I can go ahead and replace that policy because there's an additional benefit. If they already have living benefits and there's no additional benefit or it's going to cost more for the insurance, unnecessary replacement, it won't be allowed. A worker is entitled to Social Security disability benefits if all of the following are true, except for which one? Entitled to Social Security disability benefits if all of the following are true, except for which one? This one's going to be D. The worker cannot perform his or her current job, but is actively seeking other employment. If you are actively seeking other employment, then that means you are not disabled in the government's eyes, right? So the definition of disability in the government's eyes is unable to perform any meaningful, gainful activity, which basically just means that you are physically unable to produce an income for yourself. Which if you're looking for employment, is not true. So you're not technically disabled. All right, guys, that brings us to the end of video 2. If this was a little bit difficult for you, go to the link down below and study your vocab Quizlet before moving on to the next videos. And I'll see you in part 3. Bye, guys.